Hello, everybody. My name is Lindsay Bryan Podvin. I'm the founder and CEO of Mind Money Balance. And today I wanted to bring on a guest to talk about the more practical side of a series of questions that so many people wonder about, which is student loans. For folks who don't know what you do, could you give us a little rundown of what LoanSense does?
We are a tech-enabled student loan advisory that basically answers all the questions other financial professionals can't. We assign to you a highly trained student loan advisor who will walk you through a comprehensive plan that not just helps with your student loans, but can answer the implications of these student loans on other financial decisions like taking a job, buying a house, what happens to your taxes, what happens if you get married, what is the best time to file. But what the best part of what we do is we not just give you that personalized plan, we help you file and manage your paperwork into the federal programs if you decide that's the best route to take for you.
So the first question that a reader wrote in was, is it possible to raise my credit score into the high 700s when I have 6 figures of student loan debt?
So I want to talk, okay, so credit scores and credit is a big issue that people often think, oh man, is managing my debt gonna hugely impact the way I manage my debt, whether I get on an income-driven plan, maintain the current plan, what does that mean to my credit score? And here's the news. The news is your credit score is calculated based on, I have an entire video, by the way. So if you come to my channel, that basically educates you on how credit is calculated. But student debt is a mix of credit, which actually helps your score. And then there's a part of the score that includes utilization rate, right, of credit. So what will fluctuate your score more is if you have a $5,000 credit card limit and you get, because you're moving, you have all these expenses, let's say, and you max it to like 4,500, that will more likely affect your credit than the amount of student loan debt you have because it's not revolving credit. I'm not saying that it doesn't affect your score at all. I'm saying that it affects your score less than revolving credit and high utilization on something like a credit card. It still affects it because it still affects that debt level compared to your income. So I'm not saying it has no implication, but if you're worried about your credit score getting dinged due to debt, well, number one, if you've already taken out the debt, that's less you can control, but focus on the utilization of your revolving credit, which you have more control over of right now. So there are things you can do to actively improve your credit if you are a student loan borrower, which is number one, get your annual credit report every single year. Make sure to look at it. Make sure you haven't been a victim of identity theft where people are opening credit cards in your name. Another big tip is just paying your student loan on time, no matter what. So if the payment is too high, figuring out what an alternative is. And it's better to just pay on time at a lower amount if you can't afford the higher amount than it is to say, oh, I'm going to go into forbearance, I'm not going to pay it, whatever, because those decisions will highly impact your credit. So paying on time and controlling your credit card utilization rate are methods to improve your credit despite having 6 figures of student loan debt.
Okay. Can you break down for us, and I know you have a full video on it, but just briefly explain what revolving credit is? What types of credit are considered revolving?
Oh, that's a great question. Thank you for that.
Yeah.
So revolving credit is like a credit card, for example, where there's a type, like let's say you go get a car loan, right? You go get a student loan, you go get a car loan, you go get a mortgage even. Those are not revolving credit because you have a fixed credit limit for those products. You're not gonna, your car loan is for a fixed amount. Let's say it's a $20,000 car loan. That's not revolving because you're not using it at different rates every month. Your fixed amount for that car is 20,000. It's not revolving, as in your credit card. 1 month you might use 600, 1 month you might use 2,000, right? So that amount can fluctuate month to month, and that's called revolving credit. Does that make sense?
Makes perfect sense. I appreciate that breakdown. So you're saying when it comes to raising your credit score into the high 700s, when you have 6 figures of student loans, what I heard you say is yes, the student loans impact your credit score, but also check out all the other things that impact your credit score, which you obviously break down in your video. But revolving credit, things like a credit card that your use can go up and down each month, can be more impactful.
Right. It can literally fluctuate your credit score like if you max out that credit card, it could drop your credit score like 50, 60 points. So just be
Wow.
really well, and it's temporary, but
Yeah.
be mindful if you want to take out a mortgage or you're trying to think about what that next financial step is. Just be mindful of checking your annual credit and being mindful of how you use that revolving credit, because that has greater impact
Mm.
and paying your student loans on time than it is like trying to control a past decision you've made already.
Yeah. And what I
So,
appreciate about that answer is you've already made the decision to take out student loans. You already have them. So now it's about moving forward and taking action on different choices. Awesome. Okay. And then the last one's a little show and tell. So for the folks who are watching this on YouTube, you'll be able to kind of follow along with Catalina. The question is, how much should I be prepared to put down for a house when I have student loans and I'm self-employed? So we're going to do a little show and tell here based on one of the amazing kind of calculators that Catalina has created on her platform.
okay. So first and foremost, if you're part of Lindsay's audience and I don't mean to make this a pitch, but I just want to make it clear. And you're interested in understanding, getting a plan, right? Understanding what the best options are for you and your spouse. Lindsay actually has her own landing page that describes like the gist of our service, a complete overview, and myloansense.com/mind-money-balance. I'm sure she'll link it in both her podcast as well as the YouTube site. The reason I tell you this is because her page does not at this point include the calculator. The calculator is on our website. It's literally called affordability calculator. And this tool, the point of this tool is that we wanted to show people if they qualified and enrolled themselves in or got our help to also enroll them into a federal program, how much more house could they afford as a result of being on a lower payment plan? Because people think of student loans very much in isolation, but the way you file your student loans impact how much home you can afford. So in our calculator, I just put, okay, let's say I have 50,000 of student loan debt. I'm sorry, 50,000 of earnings. That's what I meant. And let's say I have 80,000 of federal student loan debt, but you could put any amount, like it changes the calculations, obviously, like 60,000 versus 80, it doesn't really matter. And you put other forms of debt that you may have, including credit card debt, car payment. Let's say I have a $408 car payment. That's a very random number, but I just heard it earlier today, so I'm just using it. And let's say you have like a 6.5% interest rate, which is like the interest rate for graduate student loans. And let's say you have a family size of 4, right? And there's advanced settings. Let's say you're going to put a down payment of 3.5%, which by the way, I know that's the next question. So I'll save it for that question, but you don't even need to do step 2, which is the advanced settings. It's more as the mortgage part. So basically what our tool here highlights is what is your fully amortized standard payment amount based on this, you're paying off every penny on that interest rate versus your family size, your income, and several factors. It doesn't take into account every single factor, right? But a good amount of them, what your payment could be. In this case, it's $89, which is reducing your student loans by, I'm sorry, I didn't mean to scroll, by $800. If you reduce your student loans by $800, literally, what does it mean? The amount of house you can afford. This $800 extra that now could be put instead of towards your student loans, it can be considered by your lender to be put toward your mortgage loan, increasing your affordability by $132,000. So before you could afford $90,000 house because they're assuming you're going to pay all $900 a month and they're like, oh my God, your debt's too high. You can't afford that. If you were to go on one of the income driven repayment plans, which might not be exactly 89, but around 89 based on these factors, you now can afford a $222,000 house. And that's 132,000 more. I'm not ever trying to endorse to go out and max out everything you can afford. Of course, we're not recommending that. What we are recommending though is to understand the implications of holding student debt and understand the implications of paying your debt off versus what you're foregoing, and understand how your student loan decision impact your ability to get a house, your ability to retire, your ability to get married, etc. So this is one of the many tools we have built to help people just balance the decision of pay off debt faster or actually go towards buying a house, right? Because you're still paying that rent payment. So that's equity you're never going to build. So if you do have the opportunity to buy, the credit and the ability and the stability, and you know where you want to be, then how does that impact you in terms of affordability, right?
Yeah, yeah. So yeah, so that is super helpful to see if you get help with your student loans using something like LoanSense, you can shift the amount of money that you're putting toward your student loans and put it toward equity in a home, which is what this home affordability calculator does. So Catalina, part two is how much money should we imagine that we're going to put down, which is a really hard question to answer, but
no, it's not.
Okay.
It's not hard. So first,
Okay.
really quickly before you if you're interested in actually getting like beyond an estimate and getting actuals, you just click this big blue button here. And then what it does is it explains the step. You get a free plan, you get a personalized plan, and then you can actually enroll in the LoanSense program if you want help. Not only do we help with the student loan side, we can also introduce you to a lender in almost all 50 states. It's 49 states that we have been committed to being trained by us so that they literally, their commitment has to be don't turn people away to help them get a plan. So if you want to buy a house and you meet with one of our student loan advisors, not only do we help with the student loan, we help you come up with a comprehensive home buying preparation plan. You will leave with an entire plan, understanding how much you need to save for a down payment, understanding exactly how to pay off any debt, and we'll understand exactly what are the implications for buying a house, and you'll actually leave with a very concrete plan. So now with that being said, what should you expect to pay for a down payment, right? I'm going to stop screen sharing now. Basically, people think, oh my gosh, I'm going to buy a house. I have to save 20%. So if I'm going to buy, if I'm going to buy a, $300,000 house, I'm going to have to save up $60,000. And that is simply untrue. To qualify for conventional lending, you only need about a 3% savings. I never tell people just straight up 3% because there's going to be closing costs associated with it. There's going to be some moving costs. There's going to be some other ancillary costs. So I would say about 4 to 4.5% to be safe. So that's part of understanding and why we decided to move towards helping people with the home buying prep plan, because we can help you break down that savings from a monthly level based on how much you have saved now and when your goal is to buy a house, right? We also have relationships with lenders who can also help you individually understand, can you qualify now? How much would you need exactly? And that could help fuel our basically down payment savings plan for you, as well as our home buying plan for you. So just know you don't need 20%, you need less than that, but exactly how much also depends on, what loan program you're going towards, but it's about 3 to 3.5%. What loan program are you going for, and also how competitive the market is. So there's a few factors, but you definitely don't need 20%.
Oh, what a relief for people, because I think that is the number that's been drilled into us. And it's also, yes, you can put down that much, but you also can put down a different number and not kind of have yourself living paycheck to paycheck. So Catalina, thank you so much for answering all of these questions. I know they were all over the place, and you were such a champ to just jump in and fire away and answer those questions.